Okay, guys, so let's talk about understanding lot size, guys. This video is very important, so please watch this to the end of the video. This is where most traders fail or don't do well at all at trading. So, lot size is basically determines your potential profit or your loss. So, it's super important that you understand how it works because many traders fail because they don't understand how to pick the proper lot size, understand it. So, we're going to talk about everything, guys, on what is a lot size, how to calculate what lot size you're supposed to do, understanding the risk, how to calculate the risk, and everything, guys. Definitely watch this whole video. Um, for one, guys, 0.01, just to keep it simple, it's changed a little bit depending on the pairs, but just to keep it general, guys, 0.01 is 10 cents a pip. So if I wanted to take a trade and I wanted to do 10 cents a pip, before I take the trade, I would put in 0.01. That means that if the market moves 10 pips up, I made $1 because I gained 10 cents every trade. Or the market moved 10 cents against me and I lost 10 pips, I lost $1. So for example, if I put in 0.03, that's 30 cents a pip. If I put in um, let me fix that, 0.07, that's 70 cents a pip. Now, if I want to do $1 a pip, very simple, 0.10. Now that's $1 pip. So if we took a trade and we aimed for 25, and we say, look, we gained 25 pips this trade, and you did $1 a pip, you made $25. Or we lost 25 pips, then you lost $25. Now, if you wanted to do, for example, $2 a pip, you do 0.20. If you wanted to do $4 a pip, 0.40. If you wanted to do, $7 a pip, or if you want to do $7.50, there you go. Now, $10 a pip, very risky, right? Well, depending on your account size. So $10 a pip would be 1.00. So if you wanted to do $15 a pip, you would do 1.50 because 50 is $5 and 1.50 would be 10 plus 5, which is $15 a pip. Or you want to do $15.50, very simple, right? If I wanted to do $20 a pip, if I wanted to do $70 a pip, and so forth. And obviously you can put in your stop loss and your take profit, right? So we're going to go over there in a minute. So how do you determine, okay, what lot size you're supposed to pick? So many traders, they teach you, let's bring my calculator up. They teach you, so look, every $100 you do 10 cents a pip. So if you have a $300 account, you would do a 0.30. I mean 0.03. If you had a $1,000 account, you would do 0.10. So if you had a $2,000 account, you would do 0.20. This is completely wrong. You don't trade like this. Because here's the problem. How you trade is you want to risk a certain amount per trade. So for example, if I have a $1,000 account, and I say, look, every time I take a trade, I want to risk, every time I take a trade, I want to risk per trade 2%. That means I'm risking $20. So if I have 4 different trades open, and I lose all 4 trades, I lost $80. Versus, let's say I have 4 trades, right? And one trade had a 30 pip stop loss. And let's say I did $1 pip using that logic, right? I had $1,000. One trade I lost, that's $1 pip, that's $30 loss. So 30 minus, then I took another trade, right? I said I'm at 970 right now. I took another trade, let's say it had a 50 pip stop loss. So if I did $1 times 50, that's a $50. So right now I got 970 minus 50. Then I take another trade and I lose $10. So $1,000 minus 10 minus 50 minus 30 minus, let's say another trade, I had a 100 pip stop loss. Or let's say 80 minus 80. So I'm at $830 and I'm wondering what the heck is going on, right? Versus if you lost all 4 trades, you would have lost $80. If you did 1% of risk and you lost all 4 trades, you would have lost $40. If you did 3% of risk, you would have lost $120. Now, obviously, the more you do per risk, the higher you can make more money, but also the more you can potentially lose. I always tell people whatever risk is between 1% and 3%, you should consistently aim for. So if you always want to do 1%, always do 1%. If you always do 3%, always do 3%, because then it's consistent. So when you win, you did 3% risk to win. Well, you did more than that. So I'll give you an example. Let's say that we kept them. Let's say we did 3%, a 3% risk, right? And we lost 4 trades. We lost $80. No, we lost $120. Now, let's say we won 2 trades, but we did a 3% risk. So we're doing, for us to lose 3% of the account, that's $30, right? So I lost $30 4 times. So that means I was doing a 0.10. Now, let's say that we finally won. We lost 4 trades, but we finally won 2 trades. And those 2 trades we were aiming for 60 pips. So let's do times 2. That's 360 minus the 120 we lost. So now we add that 1,000 to what we had. We're at $1,240. So that's why it's good to be consistent with your trades, because you want to make sure you pick the right. You always picking the same risk. So when you gain in profit, you don't want to do 1% one time, then 2% sometimes, and 3% sometimes. You always want to do the same thing. So always know your risk. Now, how do you figure out your lot size to their risk, right? You're not good at math. Maybe you is. I know I'm not. So this is what you do, guys. Let's look at our Discord group. Let's just look at different trades. We'll look at big bank signals. So let's say that big bank called a trade for gold. So we'll go to a thing called the FX calculator. And all you're going to do is this, guys. You're going to pick position size. You're going to pick the pair. You're going to type in gold, for example. XAU USD is gold, as you can see. Now, you're going to put in how much your account is. And so this guy's excited, right? So you're going to put your account size in. And so we're going to do, let's say your account size is $2,000. And you want to risk 3%. So you need to figure out what is your lot size going to be. So you're going to change this part from pips to price. So you're going to put your entry price in. Our gold entry was 1779. And our stop loss is 1774, as you can see. So 1779 was entry, 1774 was stop loss. Now we're potentially risking $60 for that trade, because that's what, 3% of that trade. For me to do that, my lot size is going to be a 0.10. So what I would do is go into my trade, trade 4. I would look for gold, add it, hit trade. You'll put in 0.12. Stop loss, 1774. Take profit, 1783. This is an old trade, so it's probably not going to go. And then your trade's done. So that's all you got to do, guys. That's how you figure out your lot size. It works the same for any pair. We'll do USD JPY. So remember, guys, it's based off of what you want to risk per trade. So every time you about to take a trade, you just put in Euro JPY. So right before you take the trade, just to figure out your lot size, Euro JPY. Oh, it's USD JPY. So 132.32. 132.32. Stop loss, 131.70. Got my risk at 3%. Let's say my balance is $2,300. I'm risking $69. I'm going to go USD JPY. My lot size is you can pick the standard lot one. So 0.12. So the same thing then. So stop loss. So stop loss, you just go to trade 132.70. Take profit 131.70. And it says tick through a sale. Now, obviously, this is an old trade, so it's probably done, but I'll just give an example. So that's how you choose your risk in every trade. It's a little different when you're looking at the gold and stock group. So you would need to go and look at that video on how to do those trades. But for every other pair, every other currency, it's on here, including cryptos.